Hello and welcome back guys in this new session. So today what we are gonna be covering is cloud. Okay, so it is from a SPR's exam kit, question number 18. So what we've been given in the question is that background information of cloud. A cloud is a public limited company is preparing financial statement for the year ended 31st December, okay, 20x1. The profit figure reported in the interim financial statements are lower than shareholders expected, and operating cash flows for the year are below budget. Okay, net operating cash flows for the year are below budget. Directors of cloud receive a bonus if cloud's operating cash flows and profit before tax exceed a predetermined target for the year. So operating cash flows as well, if it's higher, they receive a bonus. Okay, the finance director is perceived to be dominant personality, and the members of the account department, many of whom are ACCA members, follow his instruction without question. Ooh. Presentation of loan in statement of cash flows. Cloud has entered into a long-term contract with a major customer and renegotiated a new bank loan on the strength of this contract. Okay, so it has entered into a long-term contract with a major customer and negotiated a new bank loan on the strength of this contract. Okay, based on the previous contract, right? The proceeds of the loan were received in the current period and are to be paid over 4 years to 31st December 20x5, right? Over 4 years. So cloud has reported the loan proceeds as an operating cash flow sheet. Nope. This changes the size and scope of the equity or borrowing, right? So it should be reported in financing activities, but it has shown it in operating cash flows. This is completely wrong. So what else has happened? So share sale, right? So during the period, Cloud sold 5% of the equity shares of Fog for 2 million. Prior to the sale, Cloud owned 100% of the shares of Fog. Okay, so 5% for 2 million it was sold, right? So how much did they actually give them? So this is control to control scenario, right? And this transaction between equity holders, because the control has not been given up. So out of 100%, 5% is gone. The transaction has improved Cloud's cash position while enabling it to retain control over Fog. Control is there, that means at the date of the share sale, the goodwill and the net assets of Fog were carried in the consolidated statement of financial position at 5 million and 25 million. Okay, so goodwill at disposal and net assets at disposal date was 5 and 25, right? So 30 million and then 5, right? 30 million into 5%, that's what they gave them. The non-controlling interest at acquisition date was measured at fair value. Okay. Cloud has recorded a profit on the disposal of shares in the consolidated statement of profit or loss. Why has it recorded a profit or on the disposal of shares? Because since this is only like transaction between thingy, so between share equity holders, right? So that means only effect will be on cash and then other component of equity and NCI, nothing in profit or loss, right? So why has it reported a profit or loss on disposal? They should not do that unless they have lost control. Okay, so they have done that as well. So revaluation of property. Okay, so Cloud purchased an item of property PPE for 10 million on 1st Jan 20x0. The remaining useful life was estimated to be 5 years. So 1st Jan, right? So that means we are after 2 years, right? We are preparing it. So it was 5 years. That means the depreciation would be 10 divided by 5, 2 million per year, right? So at 31st December 20x0, the carrying amount would be 8 million, right? And then the asset was revalued to 12 million. That means the differential amount of 4 million will be credited in OCI, right? And then at 31st December 20x1, the asset's fair value had fallen to 4 million. Oh, so from what would be the carrying amount during that period, that needs to be determined, and that minus this, right? So during that period, how much will it be? Okay, so that is for 1 year, right? And then 12 will be 12 into how many years are remaining? 3 divided by 4, right? Hmm, 9 million will be the carrying amount. So how much was the downward revaluation? 5 million, right? So how much was our OCI earlier on? 5 million, 4 million, right? Okay, so 4 million will be exhausted first of all, and then the rest will be charged in SOPL, right? So what did it do? The downward revaluation was recorded in other comprehensive income. So that means, okay, full everything. That means they charged the whole 5 million over there. That means profit was understated by 1 million, right? So we need to talk about that as well. So what are we required? Explain with suitable calculations how the above transaction should be dealt with in financial statement for the year ended 31st December 20x0. Discuss the ethical and professional issues raised. Professional marks will be awarded in this question for the application of ethical principles, right? So first thing first, let's not forget presentation of loan, right? So first thing first, presentation of loan in statement of cash flows, right? And what is the other problem? Sale of share, right? Sale of shares. And then the third is revaluation. So presentation of loan, right? IAS 7 STAT statement of cash flows says that cash flows from operating activities. So isn't that what they had done? Operating, they had shown the loan in operating, right? Activities are cash which is principally derived from operation of the entity, such as cash received from customer, cash paid to employees or suppliers, cash paid to employees, and other operating expenses. Whereas cash flows from financing activities are those that change the equity or borrowing structure of an entity, or you could say size and composition of the equity as well, or changes the equity or borrowing of an entity, right? And investing is basically right. Okay, so once that is said, the cash received from the bank is borrowing as such. It should be reported as a cash flow from financing activities, right? The current treatment is overstating cloud's operating cash flows, which is likely to make cloud look more liquid than it really is. It may also improve the perception of its long-term sustainability. It is basically distortion of the figures, right? That gives completely wrong message to the investor from whole new level. You could say that as well. You could basically say that as well. Okay, so you could say like uh, including the cash received from the bank is should be as borrowing. If it is included within operating cash flows, the users of financial statement will think that the cash has been received from day-to-day operation, right? With the involvement of management, but that's not the case. So let's talk about sale of shares. So what had they done? What had they done was 5% for 2 million, 100% was owned, and then this was at disposal. NCI was measured at fair value. So Cloud has recorded profit on the disposal of shares in the consolidated financial statement. They should not be doing that because that will overstate the profit, right? So since this is only a control to control scenario, okay, we need to talk about that. If sale of shares results in loss of control over a subsidiary, then a profit or loss on disposal should be recorded. If there is no loss of control, then there should be no profit or loss on disposal and no remeasurement of goodwill. Instead, the transaction should be accounted for in equity as an increase to the non-controlling interest. Cloud has incorrectly recorded a profit on disposal in the consolidated statement of profit or loss, which will overstate the profit. Profit and should be removed, right? So let's give them the figures as well, okay? So that way it'll be more credible. Cloud should account for an increase to the NCI. This will be as the percentage of the net assets and goodwill at disposal date sold to NCI, right? This amounts to dollar how much? Okay, so it's 30 million, right? So what is it? I'll just use my own calculator. 5 plus 25, right? So 30 into 5. That will be 1.5 million. Okay. So this will be dollar 25 million plus dollar 5 million. The difference, so how much did they receive? How much did they receive? 2 million, right? The difference between the cash proceeds and the increase in NCI is accounted for an increase of $0.5 million in other component of equity. Yes, right. How much? 2 million. How much did we give them? 1.5. So there will be debit. Because we should have given them 2 million worth, we only gave them 1.5, right? So C will be 0.5 million, right? So this would be the entry. So what did they do with the revaluation? And downward revaluation was recorded in OCI, right? So we need to calculate this one as well. So first of all, let's talk about IAS 16. States that revaluation gains on property, plant and equipment should be recorded in other comprehensive income and held within reserve in equity. as other component of equity, right? Revaluation losses are first charged to OCI to the extent that revaluation reserve exists for specific assets. Okay, so remember we did a question earlier where they were like trying to use the other assets revaluation for the whole unit, trying to do something like that, like, so it should be of that specific assets as well. Any excess revaluation of the balance on the revaluation reserve is charged to profit or loss, right? So in this case, what has happened at 31st December 20 X not there was a revaluation gain of $4 million. How did we get 4 million? Let's tell that as well. So 10 minus its depreciation, right? So $10 million minus, so let's use a different bracket, okay? Divide by 5. 10 million into 1 divided by 5. No, no, 1 is already been exhausted. So 4 is remaining, right? And this revaluation gain will be recognized in OCI and as a revaluation surplus in equity. No, why am I doing this? So this is 12 million minus carrying amount should be right? Carrying amount is that. And at bold again at 31st December 20x1, carrying amount of the asset is, so it was 12, right? So the remaining life will be, so something. So $12 million minus in bracket $12 million. I don't need that. Divide by 4. 12 million into 1 divided by 4, right? Which will be 3 and then 9 million, right? $9 million. Let's change this bracket as well. Right. After that, what has happened during this period? The fair value has fallen to 4 million, right? So the carrying amount was 9, so it has fallen down to 4. Revaluation has, or after the revaluation, revaluation assets value has fallen to $4 million. So $5 million, which is basically $9 million minus revaluation loss has occurred. Since we have a revaluation surplus of how much revaluation surplus did we have? 4 million, right? It is exhausted completely, and the remaining $1 million is charged to profit or loss. Hmm, If it is not done, if it is done otherwise, then profit will be overstated. If it is done as per question, will be overstated by $1 million, right? So it says like everything is charged to other component of equity. So what are the ethical things in this three issues? So all things are pointing towards overstatement of profit. So that means there is a intentional. It is intentional, okay? Directors have a responsibility to faithfully present transaction that the entity has entered into during the year. As many users rely many users make economic decisions based upon financial statement. Being a professional accountant, it is as important that the trust is not broken. And principles outlined within ACCA's Code of Conduct, Code of Ethics are strictly followed, right? Directors receive bonus based upon profit and operating cash flows, right? This self-interest threat financial statements, right? And then the error in classification cash flow disposal of profit, disposal profit, and incorrect for downward revaluation of PPE suggests that misstatement was deliberate as it has overstated profit, thus meeting the bonus target, right? The question does not clearly specify who processed these incorrect accounting entries. However, the other accountants still have legal responsibility not to mislead the users of financial statement. May be that they are intimidated by the dominant finance director. They should consider reporting any concerns to directors if possible, or they could highlight these issues to the audit committee or external auditors, right? Of course, it may be that the misstatement were legitimate rather than a deliberate attempt to meet profit and cash flow targets. Nonetheless, accountants have responsibility to ensure they are professionally competent thus possessing insufficient knowledge of IFRS and IAS standards constitutes an ethical issue. This is the case, and the finance director and or relevant members, it's either finance director or the members or both, account departments need to actively seek out opportunities to continue their professional development. Okay, so this is what basically they should do, right? So this is how we should be answering the question. Okay, so yeah, if you have any questions until now, please do comment down below. I'll definitely answer it for you, since we have already completed all of these things. So it's pretty basic stuff that they are talking about. So even so, if you have any, even though it's a basic stuff, even so, if you have any questions or if you have any doubts, please do comment down below. I'll definitely answer it for you. Not only this only question, like any other questions, any other regarding SPR. Okay, so yeah, I'll be happily giving you the answer. So see you in the next question. Bye bye.